Hey folks, in this video we're going to talk a little bit about inflation, higher inflation that we're seeing, and some of the latest inflection points in inflation and inflation expectations. I do think what you're going to see here is potentially a little bit of a lead into what we might expect to see Wednesday, and as a result it's possible that we're going to see a little bit of a bump in crypto pricing. We'll see. I did increase my position in Ethereum just yesterday when we were sitting around the high 34 level in Ethereum, and I'm not opposed to adding a little bit more with cash that I just have on the sidelines sitting in my Coinbase account as we see some of these catalysts draw near. But of course, Wednesday's going to be a big day. So anyway, let's get into some of the sort of prefaces that we're seeing to what's coming Wednesday right now. Take a look at this. So we've been thinking that used car prices would inflect downwards, and they have, but they started coming up again. Now, they didn't originally go back to their May pricing when we last looked at this Manheim Vehicle Index, which is an index that tracks used car prices. As of last week is when we last looked at this index. And we thought, okay, all right, so there's an inflection back to the upside in the Manheim Used Vehicle Index, but that's okay, you know, so it came back up a little bit. It's not going to keep going, is it? Haha. Well, look at the chart right now. So here's your May pricing. This was sort of that inflection point to the downside in the shelf we hit. The used vehicle index as of today is now actually a chunk above where we were in May. In May, we had a reading of 203, coming in now at almost 205, which is incredible because we were expecting this to rotate to the downside. Now, right now, that is only 1%, but the chart gives us an idea of potentially this inflection point again in the market where we do see prices that came down temporarily as expected, but then as not expected are skyrocketing back up, and that's not good. Let's take a look at lumber just as another example here. Take a look at this. Wow. The LBS now back over 700, almost back to 725. This is lumber. If we zoom out to the 6 month, we'll see this massive plummet in lumber prices, but it's really not until when you go out to a year or even the 5-year chart that you see this incredible spike here with the pandemic. Yeah, the pandemic, I would say, well, let's see, recession, let's see if we can find it. So recession's right here where my mouse is, where we went from lumber prices of about 446 down to about 300. Lumber prices then proceeded to skyrocket excessively to about almost 1,600. That has substantially fallen since in the last 6 months here, but which just drop was expected. The drop is definitely expected. However, what again is not expected is the fact that look at the last month here, folks. We've been straight up in lumber prices again. And this is the danger that we're facing right now, is we're facing this scenario where, golly, we thought prices were going to go down. They started going down. Everything started suggesting that central bankers were right. Inflation was temporary. Everything was going to be transitory. There were going to be two big sort of bouts of inflation. There was going to be one when we compared base effects. That was going to be April, May, June sort of data that came in. And that's comparing to the whole of the prior year to see a year-over-year boost in numbers. And then the second was going to be the reopening, that we would see a surge in spending at reopening, but then we would see a subsequent slowdown. And we actually did. We saw a surge in spending this summer. And then as we started seeing Delta come back, we actually saw a slowdown in consumer mobility, in spending, consumer confidence. Everything really rotated back to the dark side around the end of August, the end of July to the end of August. However, as Delta has vastly dissipated, we're again seeing somewhat of a resurgence, and now we're seeing flight cancellations, supply chains stressed more than ever before. Things aren't getting better. In many cases, they're getting worse. Shipping timeframes and freight timeframes are worse than expected. You look at the Port of Los Angeles, usually has one docked freight ship, now has somewhere around 80 docked freight ships waiting to be unloaded. All of these things are driving prices up. And again, we're seeing this inflection here in not just lumber, but in the used vehicle index. Aluminum's also at an all-time high right now. It's somewhat unbelievable how persistent the inflationary powers have been. And earnings are going to reflect pain because of this. And I think this is why you are starting to get some more downgrades as well before we head into the earnings cycle, as institutions try to sort of call the inflection to the downside so they can show that, oh, we're right. But anyway, yeah, it's going to be a big issue that we're going to have to pay attention to, or the inflationary fears. Now, I will say the markets are surprisingly resilient in how they're pricing inflation. If we go to the 10-year Treasury bond and we look for rates, we can oftentimes see this as a little bit of a forecast of what the market thinks inflation is going to do. And what was very interesting was we spent some time kind of stuck at about 150 to 155, and there were a lot of forecasters suggesting, okay, we're not going to go back to that 172 or whatever that we had previously. We're just going to level out by 1.5 to 1.55. And that always seems like it's an argument of forecasters, is that, oh, if things are going wrong, don't worry, it's just leveling out, it's just temporary. Yeah, well, now we're at 1.61. Let's see what the 10-year break-even's doing. 10-year break-even Treasury rate. So 10-year break-even, nice way to also look at what's happening in terms of inflation expectations. And basically, as this inflects up, inflation expectations are going up. So take a look at this right here. You've been pretty flat here on the bond market. Really from April through about September. You've been relatively flat with the exception of a little pop here in May. And then, of course, we're going into the beginning of the year, we saw a nice rise here in the 10-year break-even rates. We're finally starting to see an inflection up again in how this is being priced. And when you see, it's a little easier to see it here. You can kind of see this little trajectory here since about September 22nd, where the 10-year break-even's moving up again. And if I zoom in a little bit more recently here, since the 22nd, you could really see this nice move to the upside here. And again, and here's May. And again, this is the 10-year break-even, which tends to be a little bit of a forecast for what the market believes inflation is going to do. And we are getting a very similar May-esque style push, which it's worth noting that in May, we had some pain in the markets. Some stocks dramatically oversold. For example, take a company like Enphase that in May sold down to as low as about 108, 120, as opposed to really trading mostly sideways around that 150s where we've kind of been. And this was actually such a low sell-off that you had the company itself buying its shares back as they saw it as relatively oversold. So, which ended up, of course, being a wise play. But look, it's everything. And now folks are even suggesting that Biden's vaccine mandates for companies with over 100 employees are going to lead to even more worker shortages, more labor shortages, a lower labor force participation rate, and more service-based price inflation, which one of the big fears for inflation is service-based pricing. So we'll have to keep an eye on that as well. Service-based pricing and rents are going to be two of the major factors that lead inflation to potentially inflect up. Plus, of course, some of our OGs, like car prices, which we've seen car prices now move up. Here's actually a comment. We'll throw it up on screen here. This is an interesting comment. It sort of piggybacks off of my talk about a lot of folks getting their flights canceled this weekend. Southwest having about 27% of their flights canceled on this sick out movement, where people are calling in sick in protest to vaccine mandates. Here's a comment. Both of my parents work for the airlines. I think it's funny if people in the industry say the airlines. American Delta and regional air traffic controllers are planning more sick outs before they're laid off for no vaccines. Half of pilots are ex-military. Something to think about. Yeah, that's incredible. So let's see here. Here's so for example, some other comments here in the chat. I would quit my job before I ceded to a vaccine mandate.